When financial analysts discuss the health of the American housing market, the conversation almost always gravitates toward the extremes: the explosive booms of the Sun Belt or the tech-driven volatility of the West Coast. The Rust Belt and the Mid-Atlantic are often treated as static low-growth afterthoughts. But in the current economic cycle, ignoring Pennsylvania is a strategic error. The Keystone State is currently flashing a unique set of signals that defy the national narrative. It is becoming a leading indicator for what happens when a mature legacy market faces the dual shocks of affordability compression and industrial reinvention. What we are witnessing in Pennsylvania right now is not a simple story of growth or decline. It is a bifurcated re-rating. While transaction volume in traditional hubs is slowing under the weight of interest rates, we are seeing pockets of intense, almost frantic activity in areas that were historically overlooked. The signal here is clear: capital is not leaving the state, it is rotating. It is moving from high-tax, high-regulation urban cores to secondary markets that offer a specific blend of affordability and lifestyle utility. This rotation is creating winners and losers at a speed that is catching even seasoned investors off guard. If you own property in Pennsylvania, or if you are looking for a stable haven in a volatile national market, you need to understand the mechanics of this shift. The data suggests that the sleepy Pennsylvania market is waking up, and it is behaving in ways that contradict the broader U.S. housing correction. But there is a hidden legislative factor driving this rotation that most out-of-state investors are missing entirely. In the second half of this report, we will reveal a specific tax abatement trigger in certain counties that is creating an artificial ROI boost, effectively subsidizing new development while punishing legacy assets. The tale of two cities: Pittsburgh versus Philadelphia. To decode the signal Pennsylvania is sending, we must first look at its two economic engines. Historically, Philadelphia and Pittsburgh moved in relative correlation. But in the current cycle, they have decoupled. Philadelphia is currently facing urban core compression. The city center is dealing with the same headwinds affecting major metros: nationwide commercial vacancy, public safety concerns, and a wage tax structure that penalizes high earners. We are seeing a softening in the condo market and a slowdown in luxury transactions. The bid-ask spread is widening as sellers hold on to 2021 valuations while buyers price in the rising cost of city living. Conversely, Pittsburgh is emerging as a resilience hub. Its economy, having pivoted from steel to healthcare and robotics decades ago, is proving remarkably durable. The housing stock here remains some of the most affordable in the nation relative to local incomes. This affordability floor prevents the kind of dramatic price crashes we are seeing in the West. In fact, in certain Pittsburgh suburbs, we are still seeing multiple offers. The signal is that in a high-rate environment, affordability is the ultimate defensive moat. Now that you understand how affordability protects a market like Pittsburgh, you must see how that same demand for value is spilling over into an entirely new asset class. The next trend isn't about the big cities at all, it's about the sudden explosive rise of the tertiary towns that were once considered flyover country. The rise of the secondary cities. The most unexpected signal coming out of Pennsylvania is the surge in demand for its secondary and tertiary cities, places like Allentown, Bethlehem, Lancaster, and Reading. For years, these were industrial towns struggling with identity crises. Today, they are commuter colonies for the modern hybrid worker. We are seeing a massive influx of buyers from New York and New Jersey who are priced out of their home markets but are only required to be in the office 1 or 2 days a week. They are trading a cramped apartment in Queens for a historic row home in Lancaster, pocketing the difference and enjoying a walkable urban lifestyle at a fraction of the cost. This capital injection is driving gentrification at a rapid pace. Home prices in the Lehigh Valley have outperformed the national average significantly over the last 12 months. This is geo-arbitrage in action. Buyers are exploiting the price gap between the tri-state area and Pennsylvania. For investors, this signals a shift in strategy. The yield is no longer in the saturated urban cores, it is in these emerging corridors where the rent-to-price ratio still makes sense. But this growth brings its own risks. As prices rise, the local workforce is being squeezed, creating a potential ceiling on future appreciation. However, while residential demand surges in these towns, a different sector of the Pennsylvania real estate market is quietly collapsing. This next signal is a warning for anyone holding legacy commercial assets. The repricing happening here is brutal, and it threatens to drag down residential values in mixed-use neighborhoods. If the rise of secondary cities is the bullish signal, the next trend represents the bearish counterweight dragging on the state's economic momentum. We are shifting our focus to the asset class that was once the bedrock of Pennsylvania's wealth: commercial real estate in legacy downtowns. While residential markets in the Lehigh Valley are booming, the commercial cores of older boroughs and mid-sized cities are facing a valuation reset that is statistically alarming. The legacy commercial collapse. Across Pennsylvania, we are witnessing a vacancy contagion in Class B and Class C office space. This isn't just a Philadelphia problem, it is affecting county seats from Scranton to Erie. Small law firms, insurance agencies, and local businesses that once occupied these historic downtown buildings are downsizing or going fully remote. The demand for 5,000 square foot office suites in 100-year-old buildings has evaporated. This matters to residential investors because these commercial properties anchor the tax base. As their valuations plummet, some trading for land value minus demolition costs, local municipalities face a revenue crisis. To plug the hole, they are forced to raise property taxes on residential owners. This tax shift creates a drag on home values. If your property tax bill jumps by 20% to cover the deficit left by empty office buildings, your monthly payment affordability takes a direct hit. Furthermore, empty storefronts and dark office windows degrade the walkability premium that drives value in these towns. A vibrant Main Street supports high residential prices. A vacant Main Street does the opposite. The signal here is clear: be wary of residential investments in towns where the commercial vacancy rate is climbing above structural norms. The fiscal pain of that vacancy will eventually land on your doorstep. But if you think the commercial slump is the only factor reshaping neighborhoods, wait until you see what is happening with school districts. The next signal is a hyper-localization trend where home values on opposite sides of a street are diverging by 20% or more based purely on school ratings. The education premium has never been higher. The Exurban flight and school arbitrage. While urban centers struggle with tax bases, we are seeing a massive flight of capital to the exurbs, the outer ring of suburbs that offer top-tier school districts and newer housing stock. In Pennsylvania, this trend is pronounced due to the fragmented nature of its school system. Buyers are engaging in school district arbitrage. They are willing to pay a massive premium to be in a specific high-performing district like Lower Merion, Tredyffrin, Easttown, or North Allegheny. In the current high-rate environment, buyers are becoming incredibly selective. They view a home in a top school district as an inflation hedge. They believe these assets will hold value regardless of the broader economy. This demand is creating inventory shortages in these specific pockets. While the state average inventory is rising, inventory in top school districts remains critically low. We are seeing bidding wars in these zones even today. Conversely, homes in neighboring districts with lower ratings are sitting on the market. This bifurcation creates a K-shaped recovery at the neighborhood level. The have districts are seeing appreciation, the have-not districts are seeing stagnation. For investors, this means the zip code strategy is no longer granular enough. You must underwrite deals at the school catchment level. A boundary line on a map can mean the difference between positive equity and a stagnant asset. Now that you understand how school districts are acting as wealth gatekeepers, you must see the final, most surprising demographic shift. Pennsylvania, a state known for its aging population, is suddenly attracting a new, younger demographic. But they aren't coming for the jobs. They are coming for the lifestyle liquidity. If the collapse of commercial real estate is a drag on the economy, the next signal offers a glimmer of long-term hope. We are witnessing a demographic anomaly that contradicts decades of census data. Pennsylvania has long been characterized as a state with an aging population, suffering from brain drain as college graduates fled to New York or D.C. But in the current cycle, that flow is beginning to reverse. We are seeing a youth influx, but these new residents aren't following the traditional job-seeking patterns of their parents. The lifestyle liquidity migration. Younger millennials and older Gen Z buyers are moving into Pennsylvania, specifically targeting the middle markets. They are drawn by what we call lifestyle liquidity. In high-cost coastal cities, their income is entirely consumed by rent and basic survival. In Pennsylvania, that same income buys them a house, a car, and disposable income for leisure. This demographic isn't moving for a specific employer. They are bringing their remote or hybrid jobs with them. They are clustering in towns that offer urban-lite amenities, breweries, coffee shops, and bike trails, without the urban price tag. Areas like Phoenixville, Westchester, and State College are beneficiaries of this trend. This influx is reshaping the housing stock. We are seeing increased demand for turnkey properties. This demographic, burdened by student loans and high interest rates, does not have the cash reserves for major renovations. They are paying a premium for updated homes, driving a wedge between the value of renovated assets and fixer-uppers. For flippers and developers, this is the signal. The margin is in the finish level, not just the square footage. But while the youth migrate to the towns, a massive industrial force is reshaping the rural landscape. The next signal comes from the ground itself. The energy corridor in western and northern Pennsylvania is heating up again, creating localized housing booms that have nothing to do with interest rates. The energy corridor resurgence. Pennsylvania sits atop one of the largest natural gas reserves in the world, the Marcellus Shale. After years of dormancy due to low energy prices, the global geopolitical landscape has renewed demand for domestic energy production. We are seeing a quiet but powerful resurgence in the energy corridor real estate markets. In rural counties where drilling and infrastructure projects are ramping up, rental demand is spiking. Energy workers need housing. This demand absorbs the excess inventory in rural markets that typically suffer from low liquidity. We are seeing double-digit rent growth in specific zip codes tied to natural gas hubs. For investors, this is a high-risk, high-reward play. It is cyclical. But right now, the cycle is turning up. Landowners are also seeing an increase in royalty payments, which injects cash into the local economy and supports property values. This commodity creates a floor for real estate prices in these regions, insulating them from the broader national housing correction. While the rest of the country worries about mortgage rates, these markets are moving based on the price of natural gas futures. Now that you understand the localized power of the energy sector, you must see the final, overarching signal that ties everything together. It's about the inventory lock. Pennsylvania homeowners are staying put at a rate we haven't seen in 30 years, and this lack of mobility is creating a scarcity trap for buyers. The final signal flashing in Pennsylvania is perhaps the most frustrating for buyers but the most protective for sellers. It is the phenomenon of the inventory lock. Pennsylvania has one of the highest rates of homeownership tenure in the nation. People here simply do not move as often as they do in the Sun Belt or the West. In the current interest rate environment, this cultural tendency has hardened into a financial wall. The scarcity trap. Homeowners sitting on 3% mortgages have absolutely no incentive to sell. This lock-in effect is creating a chronic shortage of inventory across the state. In a normal market, life events, marriage, divorce, new jobs, drive turnover. But today, the financial penalty of moving is so high that people are choosing to renovate or simply stay put in homes that no longer fit their needs. This creates a scarcity trap for buyers. Even though demand has softened due to rates, supply has fallen even faster. This imbalance keeps a floor under prices. We are not seeing the crash in values that typically accompanies a rate hike cycle because there is nothing to buy. The few good listings that hit the market are absorbed immediately. For investors, this means competition remains fierce for quality assets. You are not just competing with other investors. You are competing with desperate owner-occupants fighting over a dwindling pool of homes. The signal is clear. Do not expect a flood of foreclosures or distressed inventory to bail you out. The Pennsylvania market is tight, not because it is booming, but because it is frozen. Final verdict: decoding the signal. So, what does this complex mix of rising secondary cities, failing commercial cores, and frozen inventory mean for you? Pennsylvania is sending a signal of stability through stagnation. It is not a market that will double your money overnight, but it is also unlikely to crash by 30%. It is a defensive play. For buyers, you need to be surgical. The deal is not in the list price. It is in the location. Look for the path of progress. Towns adjacent to the booming secondary cities like Allentown or Lancaster that haven't fully appreciated yet. Look for school districts that are improving but haven't reached the premium pricing of the top tier. Be prepared to hold for the long term. This is a slow growth state. For sellers, understand your position. If you have a turnkey home in a good school district, you still hold the cards. Pricing power remains with you due to scarcity. But if you own a fixer-upper or a property in a declining commercial zone, you must price aggressively. The market is unforgiving of flaws in a high-rate environment. For investors, the yield is in the niches. Ignore the saturated urban centers. Look at the student housing markets in the tertiary college towns. Look at the workforce housing in the energy corridor. And pay close attention to the tax abatement zones. The Pennsylvania market rewards those who dig into the local data rather than following the national headlines. The unexpected signal is this. In a world of volatility, Pennsylvania's boring, steady nature is suddenly its greatest asset. It is the tortoise in a race full of exhausted hares. If you found this deep dive valuable and want to see the specific data on which Pennsylvania counties have the highest rent-to-price ratios right now, make sure you are subscribed.